All right, but let's just look at your country that you're in right now, the UK, right? So right now, inflation, I think, is what, yeah, I think CPI there is 10.1% right now, right? And just this morning, there was a Citi report that came out where the analyst was predicting 18% CPI by January in the UK. And that's under current status quo conditions, right? Where rates are being hiked. So let's say the rest of the year, the wheels really start to come off, GDP starts contracting, maybe CPI comes down a tiny bit, but then you have the banks stepping in to try to fill this massive hole that you just mentioned might be opening up beneath them. What happens to the CPI in the UK if it's already starting at, like, say, 15% when the next wave of stimulus goes out?
Well, I mean, they have got a hell of a problem. I mean, they set all this off basically by massive deficit spending on the back of COVID. COVID was the excuse, if you like. But now we have a situation where the Bank of England has completely misjudged the inflationary effects of the price level of all this money printing. As indeed, I mean, you've got a cohort of central bankers. They meet at the Bank of International Settlements every 2 months. They stay in contact with each other. They are in a groupthink. Every major central bank made exactly the same mistake. And if you look at the statistics that they put out, their expectations, they're all going back to 2% inflation, except instead of it being at the beginning of 2023, it's going to be in the beginning of 2024 or whatever. So, this is a groupthink problem. It's not just the UK. We've got it in spades. We have got it in spades partly because we are next door to Europe, which is another level of risk entirely. I mean, it really is. When you look at the policy problem that the Bank of England faces, it's only got two weapons in its armory. One is interest rates. And I can tell you that interest rates have got nothing to do with managing the quantity of money. And the second one is the quantity of money, which it manages through quantitative easing, a lot more than it manages through quantitative tightening. We've seen a tiny bit of quantitative tightening with a few bonds running off the book, maturing, and I think the Bank of England sold a few, sort of small amount of corporate bonds into the market, but that's about it. I mean, basically, they can only go one way, and that is reduce interest rates and print debt. That's all it's got in its armory. We now have a situation which is calling against that. It's got to raise interest rates. Why? Not because interest rates control the rate of money, but for the very simple reason that what an interest rate is it is compensation for the loss of possession of money, one. In other words, you give it to someone else, like a bank, so it's no longer in your possession. It is loss of purchasing power over the period which you part with your money. And also, lastly, it is the risk that you entail by giving it to someone else that you're not actually going to get it back. That is what it's about. It's not the price of money as far as the depositor is concerned. So while this situation continues, we will have sterling under pressure. And today we see the sterling dollar rate go down to 1.1750. I mean, this is a new low for the last God knows how many years. I think it went slightly lower in the Brexit situation, but post Brexit we had a wonderful rally. We went up to 140, and now we have lost a good 20% of value in the sterling. Sterling is not alone in this. It is also true of the yen, and it's also true of the euro. And you will have seen that the dollar's trade weighted has been remarkably strong. It's not because the dollar is strong. It's just it is measured against crappy currencies.
Right.
And I'm afraid sterling is one of them. And it's because the Bank of England has got itself into this situation where it cannot raise interest rates sufficiently to stop the currency sliding. So that's where we are. When it comes to the rate of inflation, I mean, the retail price index is already up something like 13%. So, the CPI actually doesn't capture the whole story at all. And we have got all the other problems. I mean, we're beginning to see mortgage rates rise, which is beginning to impact on house prices, which is extremely unhelpful in terms of stimulating the consumer, that is for sure.
Right.
We've also got another problem, and that is London is the financial center, ex-New York, for the rest of the world. And particularly, we clear pretty much all the interbank euro transactions for the commercial banking network, not the central banking network, the euro system. And that's all done through London, which basically means that London has all the Eurozone commercial banks as its counterparties. It also has the Japanese banks. It also has quite a lot of the American banks. But London has a huge, great problem insofar as this financial whirlwind to which the world is now exposed is likely to center on London. So I'm not hopeful really for the immediate outlook in London. I think it's we've got a number of factors which actually could be really rather nasty for us here.
The reason why I asked that question, and I'll dig into it just a little bit further here, which is in the past, and we just saw this response during the pandemic, the central banks would just ratchet it up and do more to try to fill whatever hole is opening up there. But this time around, with CPI being as high as it is, and as you're saying, it probably even understates the real experience of the daily lived, experience of the regular consumer. Will there be limits to that, right? In other words, the cost of living rise so sharply, so quickly from here, and it's already starting from a very high base, that the public starts really pushing back and saying, we'll almost take the slowdown in the economy than we will, our electricity and food costs jumping by double digits every year.
I don't think that's an option in front of the public. The public have to deal with what they're given, I think. Where we go from here, there are two aspects. I'll deal with the easy one first, and that is that President Putin is not done in the Ukraine. He's not done putting the squeeze on Europe. And that means that in this winter, it's going to be very, very tough in Europe. It's going to be very tough in this country. You're going to have a combination of lack of fuel and lack of food. And that's not a nice combination in the middle of the winter. It's bad enough now, let alone in winter. So I would see energy prices higher in the winter. And I'd also see food price inflation continuing. And so that's the background against which monetary policy has to be managed. I'd rather they didn't manage it, but we live in a world where central banks try and manage these things. So that is really what they face. I think that it is going to be incredibly tough. The second thing is the question as to what value does the average person place on currency relative to goods. And this is a point which was made by Ludwig von Mises, very much against the monetarist approach to the relationship between money and prices. As I'm sure most of your viewers will know, the relationship as far as monetarists are concerned is that if you increase the quantity of money, you decrease its purchasing power. And it should sort of happen maybe with a bit of a time lag, but it is a proportional thing. So if you double the quantity of money, you sort of roughly halve its purchasing power.